I'm Duncan Burns, the Chief Investment Officer at Vanguard Australia, and I'm here to talk to you about one of the most powerful ideas in investing. This idea has saved Aussie investors billions of dollars, empowered many to take control of their financial future, and allowed them to beat the vast majority of active funds and other stock pickers trying to outsmart the market. That idea is the index ETF and the index fund. Vanguard is one of the world's largest global fund managers and a pioneer of indexing. Looking at Vanguard by the numbers, we manage more than 16 trillion Aussie dollars globally on behalf of 50+ million everyday investors. And most of these assets under management are invested in Vanguard's index funds and index exchange traded funds, or ETFs as they're known. These ETFs can be bought and sold like shares on an exchange, making it easy for everyone to use indexing strategies. In this video, I'm going to explain what indexing is, why index ETFs and index funds tend to outperform actively managed funds over the longer term, and how you can harness the power of indexing in your portfolio or super fund. Put simply, indexing is an investment strategy that aims to match, not beat the market. When you buy the whole market with index funds and ETFs, you participate in the growth of local and global economies. The stock market goes up accordingly, and you get your share of that. And an index benchmark is a list of securities like shares or bonds representing the whole market or a segment of the market. You might be familiar with indexes like the S&P ASX 300 index, which tracks the 300 largest listed Australian shares, or the US S&P 500 index, which tracks the top 500 listed US shares. An index fund attempts to replicate an index as closely as possible by investing in the securities that comprise that index. So when you invest in the whole market through broad-based diversified index funds and ETFs, you get exposure to growth of local and global economies. For example, if you look back at the last 50 years of growth in the Australian economy, if you were invested in an ASX 300 index fund or an ETF, you would have received your share of those market returns. In contrast to indexing, we have active investing. Vanguard defines active investing as any investment strategy that's trying to outperform an index over time. That's trying to beat the market through stock selection or market timing. An active fund manager might do this by picking stocks they think are going to outperform, or timing the market by jumping in and out at just the right moment, or focusing on a concentrated sector, style, or theme. Active might sound like a smarter approach, but as we'll see, beating the market through stock selection and market timing is way harder than most people think. And one caveat here, Vanguard does believe active can play a role in many portfolios when it's executed well, but we'll save that discussion for another day. We're going to stay focused on the power of indexing for this video. When Vanguard launched the first retail index fund in the US in 1976, it was a truly rebellious concept. It was so counterintuitive that growth was slow at first, but with a lot of academic and data-driven support, indexing proved its worth and gradually caught on, leading to a massive shift in the way the modern world invests, kicking off what's called the index revolution. At the end of 2023, it's estimated that there's 30+ trillion Aussie dollars in index tracking assets under management globally. And for very good reasons, this number is only getting bigger. As the chart shows, global growth in indexing has been an almost exponential story, with a slow burn in the 80s and 90s, followed by a boom in the early 2000s. And closer to home, Vanguard is also proud to have launched the first Australian retail index fund. At the end of 2023, Australian index funds and ETFs account for more than 750 billion of assets under management. And that makes up about 25% of all Aussie domiciled stock and bond fund assets. And this may sound like a lot, but I want to point out that Aussie investors are lagging the globe. In Europe and the US, for example, index share of fund assets is roughly 1.5 to 2 times that level. So we have a ton of room to grow here in Australia. And something great is happening for everyday investors with the index revolution, and we need to help get the word out. So what's behind the shift to indexing? At the end of the day, the key to indexing success comes down to one thing. Let's talk about performance. As a numbers person, it's so important for investors to think about the base rate and probabilities. You could beat the market, sure, but what probability do you really want to place on that? Numerous practitioner and academic studies have shown us that most actively managed funds underperform their chosen index benchmark after fees over the long term. And one of my favorite performance studies comes from our friends over at the global index provider Standard & Poor's. And that report is called SPIVA, which stands for S&P Index versus Active. Every year, S&P measures active manager performance against their closest index benchmark, and it paints a compelling picture. This chart covers ASX large cap active managers for the last decade, and let me unpack it for you. It shows around 70% of Australian active large cap managers underperformed the ASX 300 after fees in 2023. You can see things move around a bit from year to year, but over approximately the last decade, an average of 62% of active funds closed or failed to beat the ASX 300. That's the green line. And we certainly see this active underperformance here at home on the ASX. But this is not just an Aussie phenomenon. The results are fairly consistent across Asia and the globe through the years, and we see it in bonds too. Those were one-year results, but importantly, longer-term, multi-year active results are even more discouraging. According to the SPIVA report, roughly 80% of actively managed funds either close down or underperform their chosen benchmark index over 10 and 20-year horizons. So if you're investing over the long-term horizon, the fact is when you go active, you're much more likely to be in the long-term majority of the distribution that underperforms, the 80%, rather than the smaller percentage that outperforms, the 20%. Now, it's easy to think, well, hey, I just won't pick a bad active manager. I'll just pick from the good ones. Well, it turns out that's almost impossible to do. When we look at the data, the 20% of active winners turns over quite a bit. And what academics have found is that only about the top 2 to 3% of active managers have enough skill to repeatedly cover their costs, and the other 97% fall down below that. So these are your odds. The sense that you can get rich quick with active is intoxicating. But the fact is, beating the market turns out to be an illusion for most over the long term. So if only 2 to 3% of active managers can beat the market regularly after cost, and all other active managers occasionally outperform but usually underperform, going index and getting your full share of market returns starts to look really attractive, right? And because Vanguard and other index ETF managers aim to deliver the market return reliably and at very low cost compared to active managers, it just starts to make a lot of sense. So we've covered what is happening in the index space, the growth and the performance edge. Now let's take a look at the how and the why. Here I want to shed some light on 3 reasons behind indexing's edge: professionalization, cost, and the odds of picking a winning stock. All 3 of these whys are well documented in academia and enduring global themes we don't see disappearing anytime soon. First, let's start with professionalization. Here, I'm talking about the growth and dominance of professional fund managers in investment markets. Markets continually evolve, and as part of that, the makeup of market participants, that is the type of investors we see investing and speculating, has changed in a big way over the decades. And in this simplified example, I'll put market participants into 2 buckets. Pros, think mutual fund managers, hedge fund managers, index funds, ETF providers, represented by the green line on screen. Then we have non-pros. Think amateurs, like average retail investors, ordinary people picking stocks or punting, represented by the yellow line. And this chart shows that back in the 90s, around 70% of the Aus market was comprised of institutional or pro investors, and 30% was ordinary retail traders, the non-pros. But today, the pros represent over 90%, and they dominate the market. Now, importantly, financial markets are what mathematicians call a zero-sum game. There is no natural source of outperformance or alpha. The gamble of picking stocks is so seductive, I get that. But the notion that we can all get rich by trading actively just doesn't make any sense. Because investor A can be above average only if investor B is below average. So the total outperformance of the winners must equal the total underperformance of the losers. And with that in mind, when investing, it's really important to know who you're trading against. So the key question is, who's on the other side of my trade, and why do I think that I have some sort of edge? 50 years ago, professional investors were a minority, and non-pro retail investors dominated Australian and global markets. So there were plenty of unsophisticated retail and novice investors for the pros to take advantage of and pick off. But fast forward to today, most major markets, including Australian equity and bond markets, are highly professionalized. Over 90% plus are pros, as amateur investors have increasingly shifted to professional funds and ETFs over the decades. The easy money or the willing losers have dropped out of the market. And with fewer amateur underperformers, there's less outperformance or alpha for the active managers. So the big problem for active managers today is they're no longer buying and selling with amateurs. That's why the sun has set on the average active manager. In essence, active is getting harder every year as the market comes to be more and more dominated by pro investors. And I'll bring that to life with an analogy. Professionalization of financial markets looks a lot like my friendly neighborhood poker game among mates of varying skills. The beginners lose early in the night, they hand over their money and they get forced out of the game. And that doesn't mean the game gets any easier for the remaining card sharps. It actually becomes harder as the evening progresses because the remaining players are the best ones. Well, it's midnight at the poker party. That's why the stock market's getting harder to beat and the tide of indexing continues to rise. And if you're that unlikely to beat the market with active, you might as well own the whole market with index funds and ETFs and get more of your full share of market returns. Next, let's talk about why number 2, cost. I like to think of cost as indexing superpower. All investors, active and index, are subject to the cost of investing in the market. These costs include things like management fees, spreads, research budgets, tech, and taxes. These costs can be high and they eat away at your returns over time. The higher the investment cost, the higher the odds of market underperformance. The cost edge powering indexing is actually based on some simple grade school math. The concept is this: all investors collectively own the market. So what rate of return do all investors collectively get? That's the market rate of return. Some can outperform, but that means some will have to underperform too. Remember that zero-sum game. Unfortunately, investors do have costs in getting that market rate of return. So collectively, they don't get the market return. They actually get something less. And for high-cost active, it's significantly less. And this chart shows the management expense ratio for index, that's the green line, and active, that's the yellow line. And these are funds right here in Australia. Average Australian active fund costs approximately 0.9%, or just under 1% a year. And the average Australian index fund, or ETF, costs only about 0.2% a year. So on average, an Aussie active fund costs more than 4 times that of an Aussie index fund, or ETF. And I like to think of this as most Australian index investors having a head start over the equivalent active fund investors every year. And that cost difference may not seem like much over the course of 1 year, but to highlight how cost can really impact you, in a 2018 analysis by the Australian Productivity Commission, they found that an increase of just 0.5% can cost a typical full-time worker around 12% of their super balance, or $100,000 at retirement. This could be the difference between retiring early or having to work an extra 2 or 3 years. So while a few active managers can beat the benchmark, the average active manager has not. This is why low cost is such a huge advantage for indexing. The best chance most investors have at maximizing their returns over the long term lies in minimizing costs, which is totally within their control. Ultimately, the less you pay in fees, the more what you earn stays in your account right where it belongs. It's time for why number 3, the odds of picking a winning stock. When it comes to active stock picking, selecting a winning stock is actually much harder than a 50-50 proposition. When you look at the long-term historical equity index charts like the ASX 300 moving up and to the right, doubling just about every decade, including the occasional recession, it's easy to forget that the individual stocks underpinning the benchmark don't move as a unified block. Individually, those 300 stocks are moving all over the place, some up and some down. When I first came to Wall Street, like most people, I assumed that half of all stocks outperformed the market and the other half underperformed in a given year, like a bell curve. I used to think that successful active stock picking meant selecting from the top half, avoiding that bottom half, and making massive amounts of money, or alpha. I naively thought it was a 50-50 proposition. In reality, when you look at returns stock by stock, like peering inside the ASX 300 and lining up all 300 individual stock returns from the smallest to the largest, a surprising majority of the 300 stocks are underperforming the index average by a small bit. And importantly, there are just a handful of massive outperformers. Recently, US tech stocks like Microsoft, Google, Nvidia, Apple, or Australia's biotech giant CSL have delivered some stellar returns. But most stocks are actually expected to deliver below average returns. And what this means for investors with a well-diversified portfolio is that you should expect frequent small losses from the majority of your stocks, but a few exceptionally large gains from a tiny subset of your holdings. For active managers, it also means picking winning stocks is way more challenging than a 50-50 bet. And we see the same stacked odds in equity markets all around the world. So the takeaway for investors is this: index ETFs ensure you own all these really big winners. While you do own the losers too, it's that handful of really big winners that have an outsized contribution and drive the vast majority of equity market returns. That's why investors should think of broad-based total market index funds as an optimal way to extract equity market returns, because you tilt the odds in your favor. And Vanguard's founder, Jack Bogle, captured the elegance of indexing brilliantly when he said, "Don't bother looking for the needle in the haystack, just buy the whole haystack." Time for some closing thoughts. I really feel for investors today because our industry is constantly bombarding you with lots of noise and information and promotions. Isn't it amazing that the active managers investors choose, no matter which one they choose, just happens to be better than all the others at picking the best stocks and funds? It's easy to think when you see a portfolio manager with a clever narrative on TV, the well thought out newspaper piece, data-backed ads and research pitches from the fund houses, hey, if I'm just clever enough, I'm gonna win. Well, hopefully we've cut through some of that BS for you today and lifted the lid on the way markets and indexing really works. So if there's one key takeaway I wanna leave you with today, it's that indexing is a tool you want in your investing toolbox. And index ETFs should have a significant role to play in most investors' portfolios. Let's recap. What's behind that indexing advantage? All three Y's, professionalization, cost, and the odds of picking a winning stock, they're robust, enduring global themes that aren't likely to go away anytime soon. And that's what makes the case for indexing so compelling. So the bad news is, it's really hard to beat the market. The good news is, you can still have a very successful investment experience without beating the market. That's the story of indexing. It lets you invest in an efficient way, a diversified way, a low-cost way, and a tax-efficient way too. It also enables many investors to behaviorally stay in the markets through ups and downs. There are a lot of Aussie investors out there that could improve their retirement and investment outcomes, saving for an education, or saving for a house by dialing up their exposure through broad-based total market index ETFs. So investors looking to buy the whole haystack, where do you start? For most investors, index or diversified ETFs are a good starting place. Index ETFs are an easy, low-cost way for you to gain exposure to the companies or securities in an index. ETFs trade on the ASX like individual shares, meaning you can get broad market exposure to hundreds or even thousands of shares and bonds in one single trade. Index ETFs like VAS, that's the Vanguard Australian Shares Index ETF, or VGS, the Vanguard MSCI International Shares ETF, can be used together to build an instant global share portfolio. Those index ETFs are great if you want to be more hands-on with building your portfolio. And if you prefer a more hands-off approach, Vanguard's diversified ETFs are a great one-click solution. They're ready-built portfolios that invest across a range of index funds, including Australian and global shares and bonds, allowing you to choose the level of risk that suits your investment needs. and they automatically rebalance back to target for you when the markets move. For over 25 years, Vanguard has brought the power of indexing to Australian investors. Our personal investor platform brings ETF offerings to retail investors, allowing you to get started with as little as $200. The power of indexing underpins Vanguard Super too, which is helping thousands of Australians benefit from our strong and steady approach to building wealth, up to and right through retirement. If you want to discover more about Vanguard and the power of indexing, visit vanguard.com.au and consider opening a Vanguard personal investor account. And remember, investing is a marathon, not a sprint. There's no perfect time to start, but the earlier the better. And we're here to help you get started when it's time.